I got here today Brad from Down Payment Resource Center and Kat from LoanSense. They both were contributors to the book Rethink Everything You Know About Home Buying, which we've had some recent guests on from that. I'm really excited about this conversation. So welcome, Brad and Kat. Thanks for joining us.
Yeah, thank you very much. Appreciate it. Great being here.
Thanks for having us.
Absolutely. I'm going to just jump right in. So, Kat, you specialize in the student loan section and Brad in the down payment resource section. So, Kat, first to you, what are the most common misconception about student loan and getting a mortgage?
The most common misconception for loan officers is that there's nothing you can do with a borrower who comes to you in forbearance. And there's about 10 million people right now in forbearance. They think you have to just use straight up 1% Fannie Mae guidelines. The biggest misconception for loan officers is that they have to use 1% Fannie Mae rule when borrowers come in who are in forbearance, and there's 10 million borrowers right now in forbearance. You don't have to use 1% because let's say somebody has $100,000 in student loan debt, that's $1,000 towards their debt to income. They should enter into repayment. And the big question we always get is like, well, how do you talk them into getting into repayment? Excuse me. The answer is you can't qualify for home. That's how you talk them out of it. So it's fairly easy. And also that there's nothing you could do if they're 90 days late plus on student loans, and there's absolutely something you can do. So those are the biggest misconceptions.
Okay. Brad, I guess same thing. Is there, besides people not knowing about down payment resources, is there any common misconceptions?
There are actually. I would say there's a few. One would be that it's going to be free money, right? And it could be, but it could also have a payment attached to it. So there's different types of down payment assistance. Having to have some sort of a payback. Some of the great things about some of programs is that if there is an interest rate attached or there's a payback period, it could very well be way below market rate. Like it could be a 2 or 3% interest rate on that. It could be forgivable over like 10 years. So it could actually decrease like 20% each year, your balance, like they forgive that piece over time. And then some of them are actually just grants. So that is just money. But those are some of the good things around it. Some of the things that could be thought of as negative from the borrower standpoint, or even from the loan officer standpoint, and we may get into that here today, is that, a loan officer could just think that it's just way too much work. They've had bad experiences before. Maybe your lender has bad practices. They aren't really schooled on how to efficiently manufacture that DPA loan with that borrower in that process. Set them up for success. Get them into that education class early. Don't wait till we're 20 days out. Like get them earlier in the process when you're pre-qualifying them. So there's some of the stigma around there that it's a lot of work, a lot of paperwork, and it can be for some programs, but it is really worth it. And if you take the time to learn how to do that program correctly, you're really going to help your borrower out.
Yeah, I actually have a personal story of a friend. She became a teacher a few years ago, and was starting to wanted to buy her first condo, and her cousin's an agent and referred her to another loan officer. They basically went down their own program, which didn't involve down payment assistance, and just told her she couldn't qualify. I was like, hey, just do me a favor and talk to this person. I introduced her to a local lender friend, and they do deal with the down payment assistance, and she got approved. She was ecstatic. So it definitely opens up some doors for folks. And I have seen that firsthand where it's like, I don't know about down payment resources, so I'm just not gonna do it. Do you find that that's at a loan officer level or a lender level, where lenders just don't want to deal with it?
It depends, depending on the type of lender, whether they're a community bank, credit union, or an IMB, they can have different thought processes around that. But, some of your savvier loan officers take the time to learn what's in their area. But, that's part of our platform, is that we are just helping to educate and helping to provide information. So you can just look up geographically where you are and just tell me all the programs in my area. There could be an employer program you didn't know about. There could be a program that's dedicated toward some sort of profession like firefighters and nurses and things like that, or simply just because based on a certain income level or what have you. So I think a lot of times people just don't know because either the advertising or the awareness on all sides is just lacking.
I mean, Kat, do you see similar things in your world where it just like this is kind of a foreign thing in what you do with
No, it's not
specifically
foreign at
relating to
all.
lenders?
Like it's not foreign at all. As in down payment, the biggest down payment help can help unlock a lot of people with debt to income issues. Down payment does help you afford. If you get more, the more down payment you have, or the more down payment help you have, the more home you can afford, which directly ties into the debt to income ratio, which is the problem we're solving for. So, if you talk about a teacher, right, they are middle earners, like middle income earning people. And if you live in a market outside of Michigan or the Midwest where it's they have even more affordability challenges, not saying that Michigan doesn't, but the Midwest is a little more friendly than, the coast, more expensive areas. But for example, like if your income, you're earning, let's say 60 to 70, which is considered pretty good for a teacher, then the amount you could borrow is capped. But the more down payment you come in with, then the more house you can afford because you're coming in with the more down payment. So it ties directly into the debt to income ratio. What we see is lenders, by not knowing, like I told you, the get them out of forbearance rule, as well as there's about 8 million people with 90 days late. The misconception that I mentioned that ties into this conversation is that if lenders think, oh, they're 90 days late, 120 days late, it's tanking their credit, there's nothing they could do, they have to just wait until their credit they get more on-time payments. That's absolutely not true, because the servicers did such a bad job at actually alerting people when their payments were due that we could actually just ask the servicer to remove the late payments, not the credit bureaus, but the servicers themselves. And it could be done in about 45 days in 75% of instances. What we find is over 50% of the people that come through LoanSense have been declined in the past by a loan officer, and now they're in the process of getting approved. So what I tell, it's not just knowledge loan officers have, because like to Brad's point, if we had to make it only about do they know something like mentally, we're going to decline so many people. They have to have the tools to help them expand who they can lend to. And that's not the obligation of the LO, that's the obligation of the company to provide those resources. Because at the end of the day, if you're just waiting on an LO to have the knowledge, then that literally means the most seasoned veteran loan officers can originate, and the market is aging. Loan officers are 50 plus on average. Like, we have to help younger people with less experience also be able to address the hard cases, because it's the minority with high income, perfect credit that have 20% down. Like, that's the minority of Americans at this point. We have so much consumer debt. We have so little savings right now that if you're going to get the average consumer to buy, we have to make and we have to make down payment resources. We have to make figuring out how to improve their debt to income with funds already available. We have to, like, these alternative and niche things used to be niche, and now they just need to become the market trend, or we're not going to be originating 60 to 70% of people's pipeline. It's just not going to be originated.
So I love everything you're saying there. For some of these lender clients that are watching or will be watching this, what if you just had to give them what's the biggest benefit for contracting with LoanSense to bring in additional clients? Like, how would you help their clients? What kind of clients are you helping?
Okay, so we are helping the average American, that we're helping, I say truly moderate income, who have a debt to income issue, who they're not struggling with credit. They're struggling with pure debt to income issues. And if we solve that for them, they can originate within a few months. That's the client. And we're solving it at the pre-approval early front end process. So literally, if you're taking in a pre-approval app on a soft pull, it doesn't even have to be hard. We can literally take that data and flag who we can immediately lower the debt to income for. And of course, we can help the decline pool as well, but we really need to get them before they become a decline. That's really our value prop. it's not saving the declines, it's saving from greater number of declines. So we literally truly help the average American, which 50% of mortgage pipelines have student loan borrowers right now. So it's not like a niche problem anymore. It's a everybody's pipeline kind of thing. So we want to work with lenders who want to build resources and tools to flag alerts to their LO so that they don't have to memorize how to help people, right? They could just be flagged alone when we can help. And of course, I'll turn it over to Brad. I'm sure same question.
No, it's great. I was on a webinar yesterday that we were part of, and speaking with a very successful loan officer, Mosley Gatling, and she's talking about this. It is not niche, as you're saying, Kat. Like trying to help these borrowers in these situations. This is not niche. This is like a lot of people, and as you said, 50% of yours have some sort of student debt. So, and challenges with DTI. So not even finding, for my world, not even finding DPA to have money down, but you also have DPA that you can contribute to closing costs or to MI or what have you. So, if you have someone who you can try to raise the loan amount just a little bit, but then you can use the DPA to pay down MI or pay upfront MI, now you really can lower their DTI, because MI can be a nasty piece of some of these, especially for conforming products.
It's good stuff. Brad, you highlight several like common DPA programs in the chapter in your book. What are some surprises that catch borrowers or loan officers by surprise, but both good or bad?
I think one of the newer ones since the NAR settlement last year, being able to use DPA to pay buyer's agent commission. It's not a ton of them out there. I mean, it's probably fewer than 50 programs, but they are slowly starting to add those pieces to their repertoire. So that DPA provider says, yeah, you know what, we'll also let you use funds for this. So for that, like I said, for MI, buying down MI and use it for closing costs, not just to reduce the principal. I think that's a piece that few understand that's possible.
Can I add to what Brad's saying? I mean, if lenders are declining loans right now for high DTI and they can like scan them for who they could approve with DPA, like why wouldn't they do that to originate more loans that they would otherwise be declining anyways?
Right.
I say that because it's very similar to our product. Why not scan them for debt to income improvement? Like why just send them adverse actions? It doesn't make sense. They should say, we're trying to salvage this loan, and actually legally, if they say we're trying to salvage this loan, they don't need to send out an adverse action in 7 days anymore. So if they're trying to cure an adverse action, they have more time to try to cure the adverse action before they have to send out that letter. So there's a lot of like worry, oh, well, we're not compliant if we don't send it out. But actually, if you have a specific person, division, contact, whatever process you want to create to try to save a loan, then again, you have more than 7 days, and that's more business that your lending institution isn't getting. And I know a lot of lenders have like a specific senior loan officer where their whole job is like, any LO who can't do the loan, they can send it to the senior loan officer, and anybody who's going to be declined also gets sent to the senior loan officer. And their whole job is to save deals for the company. And they don't have to go out lead shopping anymore. They can just get every loan that nobody else wants to do. And it's great for the business. Those loan officers are the ones we often end up working with very closely, because the DTI challenges are ones that a lot of LOs are like, yep, can't figure it out. Let that guy take it, kind of thing, And so I just say that because I see the companies that try to do the most salvaging have this type of division or this type of person that is assigned. And I think that that's really the key to unlocking revenue for a brand, not just at the individual LO level, but getting someone super senior that maybe They don't want to be in the market selling themselves anymore. They just want to, they like problem solving in the back of the scenes, you know?
Yeah, I mean, I completely agree with you. I'll double down on. I mean, why would you not? Because you're going to get additional deals out of it using either one of your guys' offerings. But even if they go through that and they still can't qualify, in my opinion, you've built more trust with that borrower, and they're going to be a borrower at some point, right? It might not be this year, it might be next year in 2 years, but are they going to go back to the person that really helped them explore all options? My standpoint is I would think the majority would.
Yeah.
Kat, this is back to you. So for someone who has student loans and they want to buy in the next 6 to 12 months, what are the most practical steps to get their stuff in order with the student loans? Like, what should they be checking? What should they be doing?
They should be in repayment. They should have a document that says they're in repayment with a monthly payment amount with whatever plan they're in. It has to read 12 months. And this document they needs to be within 60 days of close. And that's the underwriting guidelines that's compliant and conforming. And if they have that, they're going to make their LO's job much easier, because if they don't have that, then the LO is going to try to use 1%, which is what disqualifies so many people, because the borrower doesn't know what documentation to get and the LO doesn't know where to tell them or how to get it. It's like one of the only assets lenders can't buy from their credit provider, which makes no sense because it's one of the assets that throw off the most deals. In terms of like actually being in a program, if it's not conforming to what's in the credit report, it's the only asset the credit provider does not sell. Like they will sell tax returns, they'll sell flood certificates, they'll sell like everything, but they won't sell this doc. And this is the doc we are getting borrowers. And we're not even charging the lender for this doc. You know what I mean? So if they're going to struggle and lose deals, why not just have a partnership where we're flagging the loan and getting the docs in one flat low fee? I mean,
makes a lot of sense.
It's a no-brainer. I mean, so what to do to prepare is to like get your docs in order. Don't rely on the LO to understand what it is you're supposed to be doing on the student loan side, unless they're already working with us. And really, for me, it's about understanding really, like I like to tell people, if you have more than 6 to 12 months, the strategic time to think about your student loans is if you're between work or you don't, basically between work when you can enroll, you could get a $0 payment that can actually qualify as zero on the DTI and afford a maximum amount of home. So you should really be thinking about buying and preparing if you're a student loan borrower at least 12 months in advance. Of course, we can save deals when they're coming in, but like if you're really strategic, you could get zero debt to income and afford a maximum amount of house. And for lenders who make this like a big focus, like they're working and trying to market to healthcare professionals, they understand this and will get clients well in advance of buying. And those loan officers are people who have a stronghold with healthcare professionals and get a lot of referral business through networks of healthcare professionals, because healthcare professionals get so much student debt and that really impacts their ability to buy, you know? So I would say prepare ahead of time, understand what docs and understand the best timing is key. And of course, get your down payment in order, get other aspects in order. But the student loan is really a huge piece that makes or breaks a deal for a lot of people with high debt amounts, like 6 figures. And that's majority of healthcare workers.
And so when you say the 1%, that just from my own knowledge, that's 1% of the total student debt out there?
So what happens if people can't get their documents in order? Fannie says you have to use 1% of any loan that's not being paid on. You have to use 1% of the balance towards the DTI. Freddie and FHA say you use 0.5. But still, those ratios are way higher than the majority of people actually have to pay. So why not get the document in order that shows you're paying at a much lower clip than have the LO just use 1%? That just kills your ability. Some people who earn 6 figures, it doesn't kill the deal, but it helps them afford way less home. And it's like, why are you going in a worse position? And I'm not trying to say everyone needs to get the biggest home they can afford, but for a lot of people, if they don't maximize that ratio, they're just not going to afford enough to even buy, you know? And that's where the average person is.
Thanks. So Brad, back to you. If I come to you as, I mean, two-fold part question. One is a consumer, one is a loan officer. I come to you and say, what's the best way for me to get up and knowledgeable on down payment assistance programs that fit into my criteria?
So as a consumer, number one, we have you can use our website. You can just go on there and you can punch in your information and it will tell you down payment assistance programs in your area that you might be eligible for. You can research those programs. Sometimes on those providers' site, they'll even give you which lenders they have, some preferred lenders they work with, et cetera. Or some websites even show you the top loan officers that offer those types of programs. So that would probably be a good resource for them. And then for a loan officer, maybe the same thing. I don't want to try to sell our platform or anything, but we do have an opportunity for an individual loan officer, like in a broker situation or even with a large enterprise lender. They can have their own version of our platform. They don't have to be on a big enterprise release version. So they can use that. But either way, they can come to our site, and there's so many different ways to learn and educate yourself about down payment assistance. We just created, actually for this book, we created a checklist for a borrower. So the borrower can go on there and it tells them all the questions they should be asking themselves. Some of those questions are, hey, am I working with a loan officer who even knows what DPA is? Can they give me some guidance on different types of DPA that might be able to use for CAT, DTI, or for actually paying down something or paying part of my payment, or actually just paying down the principal. So it's a whole checklist for that, and it sets them up for success. It tells them to get their education in order. Similar to something CAT might need way in advance is, if I need to take a class, and some of these, I mean, if they're doing a state housing agency, it might be an 8-hour course that they need to do with a housing counselor, especially a first-time home buyer in certain situations. So it is incumbent upon them to take that course. Maybe the lender will pay for it for them. Maybe they won't, but they should take it in advance so that they are well prepared. And that is not something that's holding up that purchase process when timing starts to get tight.
Yeah. Just to piggyback, Chris, also like our website will give borrowers completely free plans on what it is they should do. We have a product and a site for loan officers also to crunch numbers on what a reduction is and how to send people and all that. That they don't have to, nobody has to pay us to send somebody. So we have that. And of course, like there's an enterprise version where we can run alerts, which is slightly different. But yeah, there's definitely resources out completely free of charge. Also, our chat on our website, myloansense.com, can even directly answer any direct questions borrowers or LOs have about student debt. It could literally answer them like with your personalized scenario and just answer them without logging in or anything. Just ask it. So that's available at our website as well. So tons of free resources out there before you fully need to know, before you fully need to even make a plan. It's like, go visit those resources and then you can start to understand, right, what it is you should be learning more about or doing. And of course, that helps everybody win, right? Because a educated consumer creates an easier buying and borrowing process for the LO too,
We strongly believe that here at FinLocker, and that's kind of what our mission is too. And I've engaged with both of your platforms personally, and they're great platforms for anyone who wants to just check them out. It's pretty easy to go check out. We are coming up on time, and I want to just leave with one last question, or the same question to both of you. But if you're just going to leave one tidbit for a loan officer, one takeaway from chapter in your book, what we've talked about, what you're offering, what would you say? Whoever wants to jump in first can go.
All right, I'll go first, Kat. So for me, it is assistance, down payment is not only for low income buyers. It can be for everyone. So, over half of the programs in the country have an average income above 100,000, and some of them don't have income limits. So I can make whatever, right? Any amount of money, and there may be a program that I can take advantage of. So I think, we really need to kind of reframe our take on who this is targeted for. Initially, I think a lot of folks thought it was only targeted for low to moderate income or certain census tracts, et cetera. But it really is for everyone. And it just depends on where you sit in that bandwidth.
I think that is a common misconception. I know we're sort of trying, but I want to just follow up one more question on that. Do you think that misconception is because the down payment resource just start for low to moderate income and it's expanded, or has it always been there and just people just assume that it's for low to moderate income?
I've been in the mortgage industry for 20-something years, but with DPA, not as much as my focus. I believe, looking at a lot of programs, they started out to help people in certain areas. So we want to expand home ownership in this county or in this part of town or what have you. So I think that was part of the beginning of it, but it's expanded dramatically. And
I think it's also the branding, Brad. Like it
Yeah.
was called down payment assistance. The branding was bad.
it is.
If
And
they
that's
called
on,
it like an affordability booster program
Right.
for everyone, like
I
then it
call
would
it-
be branded something different, you know?
I want to call it
That's a good point.
the equity booster. That's what we want to call it, is the equity booster.
Yeah, and equity, and everybody loves equity. Everybody,
That's
like
right.
the wealthy
Yeah.
benefit from equity
Yeah.
too, you
Yep.
know? So I think it's honestly just straight up branding.
It is our fault, and by us I mean as loan officers, right, and lenders. It is the lending institution's fault for where we are with the naming of this, and we can all do a better job there.
Kat, bring us home.
My final point, I wish I had something so I love what Brad said, but for me it's just like the key to, I find, being a good originator from my experience working across multiple brands and loan officers, is just being a trusted advisor. I know this sounds cliche and everybody says it, but if you go in with a heart, like Dave Savage always says, the heart of a teacher, and you gain that trust, people will most likely originate with where they start the process. They're not going to go do all this rate shopping and all this stuff. Like, just focus on gaining trust, and how to gain trust is meeting people where they're at. So if where they're at isn't about numbers and isn't about numbers, it might be just being like, what's your goal in life? Like, what are your goals right now? Is buying a house even right? And I think that if you find that if buying a house is not right for that person right now, and you told them honestly, buying a house is not right for you right now, or this type of house isn't right, you're going to gain trust, because it's not about closing the deal. It's about also thinking about, based on your experience, what's right for that person. And I think that's where people win. Like the loan officer I do business with when I buy is someone, and the reason I go back to him is because when I brought a house I was interested in, he's like, Kat, this house is not your style. It's too expensive. It's not going to return you enough money, and it's just a bad deal. I think you need to just continue shopping. Like, don't come, like, this is not good for you. And that was when I was like, wow, this guy, like, is great, because it's not about his pocket. It's about what he thinks is right for me based on what I've already said to him. So he built so much trust with me. He's now my loan officer for life, my mom's loan officer. And I just, that kind of, like, that's a partnership. That's someone you can trust. And that kind of trust is what makes recurring business. And I think that's my takeaway, right? So The same with student loans, you know, it's like, if you go the extra mile to help them get their loans forgiven, even if they're not trying to buy from you, of course, they're going to remember you when they are able to buy, you know?
Absolutely. I love that piece
Well
of advice. It's good. Yeah. Well, Kat, I don't think we can get better than that. So, hey, Brad, Kat, really appreciate you guys coming on, all your contributions to the Rethink series. And for everyone else, hope you guys find this enjoyable. Thanks, and we'll see you next time.
Thank you. Appreciate it.
Thanks.